In this video today, we're going to be looking at an introduction to property development finance in the UK, whether you're just getting started or looking to expand your portfolio. This video will give you the lowdown on how it all works, so let's get started. Firstly, let's talk about the size of the property development industry in the UK. The construction sector alone, which includes property development, is a major contributor to the UK's economy. In 2022, the industry was valued at over 110 billion, employing over 2.4 million people. Within this vast industry, there's a significant portion dedicated to property development, ranging from residential homes to commercial buildings. It's fairly easy for the big boys out there to get development finance, but this video is going to focus on you smaller developments out there. And when I say smaller, we're talking 1 unit, 2 unit, even refurbishments. Before we get to that, I'll just define what development finance actually is. In simple terms, it's a type of funding that covers the cost of construction and the development of the property, and can include some funds to go towards the purchase of the land or the building. It typically comes in the form of a loan, and it's crucial for turning your development plans into reality. Now let's break down the different types of finance available. There's two main types: the senior debt and mezzanine finance. Senior debt is a primary loan usually provided by the banks, large financial institutions, or investors. It covers the bulk of the project costs but requires you to contribute some equity. On the other hand, mezzanine finance is a secondary loan that fills the gap between your equity and the senior debt. It's riskier for lenders, so it comes with higher interest rates, and in reality, unless you're a really experienced developer, it's quite difficult to get mezzanine funding without some equity. After working with small developers for coming up to 10 years now, I know it can be really daunting the first time that they're looking to access development finance. Luckily, within the UK market, they have many tailored solutions for smaller developers. It does get easier the bigger you get, but don't worry, there's still plenty of options for you out there. The small developer market is mainly funded by specialist lenders, and they cater specifically to small projects, and because of this, they understand all the unique challenges that smaller developers face. Now, the key question is, what do you actually do if you want to secure development finance? First and foremost, it's worth having a solid plan. To start with, you need a lot less information than you probably think. Lenders do want to see that you've got a clear vision though, so detailed costings, realistic timelines, that's kind of important. Having these elements in place and well prepared can significantly increase your chances of securing finance. Another important aspect to consider is the actual cost of finance. There's interest rates, the term of the loan can vary greatly, so it's essential to shop around and compare offers. Remember, the cheapest option isn't always the best. Consider the lender's reputation and the support they can provide throughout the project. A lot of the developers that we work with really struggle to know exactly what to put together before they send anything off to any lender. All the developers that we work with, we have a very simple development checklist that I'll include in the link below that you can download, and also it'll be available on screen and in the description below. It's fairly simple, but I'll walk you through each question step by step. So firstly, the borrowing entity. Who's actually looking to borrow the money? Is it a limited company? Is it you in your own name? There is one little caveat to that some lenders will only lend to you in a limited company. This is for regulatory reasons, but we'll go into that another video. The next question is the site's address. Fairly self-explanatory. Followed by, does the site have planning? If so, what for? Here, the lenders just want to check whether or not it actually has planning for what you're looking to do. A lot of builders come to us when they haven't obtained planning permission yet, which is incredibly hard to find finance for. The next question is, when was the planning implemented, or when does it expire? This is key because a lot of the lenders won't lend to you if there's a very short time frame on the expiry date of the planning, simply because getting the development finance through pushes you even closer, and if you can't start the build before the planning expires, the land actually ends up being worth way less than it would be with planning. I'll just take a step back there actually, in case you don't know what implemented means. That means when you've actually started the development project. Once you've done that, the planning is then considered implemented. you'll normally have to get the council or the building control to come round, have a look to confirm that you have actually started the project. Once that's done, the planning is then what's called extant. This means that it no longer can expire. Next couple of questions, fairly self-explanatory again. How many units, what's the square footage of each property, and the current value. When it says the current value, it means the current value of the site as it is at this moment in time. So assuming it's a plot of land, just what's the land worth? Normally it's quite close to the purchase price. Again, if you're purchasing an existing building and looking to do a refurbishment, it's normally the price of the building, give or take a little bit, unless you're overpaying or getting a really good deal. Then is there any debt that needs clearing? This is important because all of the lenders, or almost all of the lenders, will want a first charge on the site. This means they have the first ranking charge if anything were to go wrong, so their loan is priority on that title. A lot of the lenders will happily put some money to repaying a loan if you bought the property previously and had to pay back another lender. The next point is the build costs and the schedule breakdown. This is essentially giving how much you're going to be spending against the time you think it's going to take. We've got a template for that as well, so if anyone wants it, just get in touch with us and we can provide one. Now comes the end value. This is also known as the GDV, which is gross development value. This is the total value once all of the work's been done. So assuming, let's say it's 2 properties, each house once completed is worth 200,000, for the total site would be then 400,000. Then comes the term. This is very important because you need to make sure that you have enough time to actually do the work that's been done. What happens if you get to the end of the loan generally means you go into default unless you can service the interest moving forward. This isn't ideal and costs a fortune, so make sure you get your timings right. Then, who's going to actually be carrying out the works? Are you using a contractor? Are you project managing it? Who's physically going to be actually building that property? If it's you, what experience do you have? They also want to know what your experience is. They don't mind the contractor if you're using that. They want to know about you. The next thing is your asset and liabilities. This is basically a list of all the things you own and the debt that you have. They want to know this so that they can get a good idea of what you're like as a borrower. Many development funders will only lend to you if you own your own property. This again is for regulation reasons. Don't worry though, if you don't own your own property, there are lenders that will still lend to you. It just is a little bit trickier. Lastly, if your project has already started and you're looking for a development lender to step in halfway through, you'll just need to get confirmation that all the work has been up to date. This can be done via builder control sign-offs, warranty provider sign-offs, anything of that sort of nature. The next topic is rate. I won't go into too much detail on this because it is very much deal dependent. It all depends on the loan to value, where the property is, etc. But I will say, as a rule of thumb, at the moment, the rates for small development finance are quite pricey. I'm recording this in 2024, but I doubt things are going to change too drastically in the next decade unless something significant happens. Rates do vary wildly. The lowest we see at the moment for small developments is around 9% per annum, but you'd be really lucky to get anywhere near that. Typically it's nearer the 1% a month mark, maybe 1.25. There are lenders that go up a little higher than that, but they're cheaper in other areas, so it's always difficult. And as I mentioned at the start of this video, don't always go for just the cheapest because they're often not the easiest to work with. With all development finance, it's important to get somebody on your side that knows what they're doing, that's done this hundreds of times before. So make sure you speak to a local broker that you know that can help you navigate that sort of thing. If you're having issues, get in touch with us. We also offer that service. I'll very briefly talk you through the underwriting process for any loan. If I wanted to go into detail, this video would be probably about 4 hours long because it's quite a lengthy process for most lenders. Firstly, the lenders will review all the information that we've sent over to them. They will then review the details that we've given them, making sure the end values, the build costs are roughly in line with what they would expect for a property of that size. Once they've had a look at the deal, they will often send out what's called an offer in principle. This is basically them saying, yes, we're happy to do the deal. Here are the rough figures subject to valuation and legal due diligence. Some lenders will also require a quantity surveyor. They are sometimes paid directly by the lender, and others you'll have to pay for that. They're basically there to help give the bank or lender a better overview of the project in terms of the construction costs, etc. You will then also need a valuation. This is what's called a RICS valuation typically, and they do a Red Book development appraisal. I won't go into the detail of what that involves, but it's fairly lengthy and also costs some money. The valuation will typically give 3 or 4 different figures. That will be the current value as is, the 90-day of that value. So the 90-day figure is what would be called a fire sale value or an auction value. Then you've got the 180-day value, which is what it would take to sell within 6 months. Typically then you'll have the gross development value, and that might have a 90-day value with it depending on what the lender requests. The lender will then review that valuation. They'll then be able to give you a final formal offer subject to legal due diligence. Assuming you're happy with those terms, the legal work starts. This is probably the most painful and lengthy process of the whole application. The lender will appoint their own solicitor, and you will have to have one as well. The 2 solicitors will then work together, passing detail back and forth between each other to make sure that they are satisfied with the clean title and that you've got all the necessary documents in place, insurance, planning permission, etc. Once that's all been resolved, which typically can take up to a month or 2, you move on to actually getting the first drawdown. To save this video, again being about 2-3 hours long, I'll briefly explain how the day 1 drawdown works and then the following tranches as well. So the day 1 is normally up to a set loan to value of the value of the property or the purchase price, normally whichever's lower of the 2. That loan to value does vary depending on the exact lender, your position, the overall deal structure, and loan to cost. When it comes to the tranches, they're fairly straightforward. Most of the time, if they have a quantity surveyor involved, they will do the sign off. If not, the lender might have an asset manager involved who will actually come and visit the site, sign off everything for you that way. Or they might have a valuer, so the initial valuer who did it will come out again to visit the project. They will say the property's now gone up X amount, which will then allow the lender to sign off a further drawdown. As you progress the build, they will do this several times, typically depending on the size of the loan, around about 4 to 5 times they will come out and visit, all the way up until the property is actually completed. One important thing to note when looking at how the drawdowns work, most lenders actually work in arrears. That means you'll have to spend the money on the build prior to them actually lending you the money, bar the day 1 drawdown. If you have builder merchants, contractors, etc., you can use their money or their credit in order to do it and then refund them afterwards with the drawdown from the lender. But we can discuss this in more detail if you need funds day 1 to actually start the build. And there you have it. Once the property is built, you literally need to either refinance the property, put that property on the market for sale, sell it and repay the lender and reap your rewards for all your hard work. Despite being a little bit of a challenge at times and relatively expensive, development finance is a real handy tool for those smaller developers that just don't have the funds to actually do the build all out of their own money. There is that old saying that you've got to speculate to accumulate, and in this case it's very much true. You have to ask yourself, can you do the project without finance? If not, is that cost of finance worth it for the profit at the end? And that's it for this whistle-stop tour on development finance in the UK. If you have any questions, feel free to leave them in the comments below. Get in touch, drop us an email. Love to hear from you. We work with small developers all the time, so do get in touch, and thanks for listening.